How investors help businesses prepare for acquisitions. First, I'll explain the difference between a passive investor and a strategic growth partner and which one might work best for you. Then I'll show you how private equity firms use buy and hold strategies to drastically increase a business's value before sale. Finally, I'll reveal how having the right investor on your cap table can open doors to new buyers that you never were able to reach before. By the end of this video, you will understand whether bringing in the right investor could help you sell your business faster and for a higher multiple. It's important to understand the difference between a passive investor and a strategic growth partner. A passive investor typically writes a check and waits for a return. A strategic growth partner brings capital and expertise. They can also bring connections and operational support for business owners approaching an exit. The right strategic partner can help optimize the business, professionalize operations, and position the business for a higher value exit. As the owner, you need to choose which path is best for your business, not just who's offering the most money. Private equity firms will acquire a platform company, then bolt on smaller acquisitions to build scale, diversify revenue, and increase the EBITDA. This combined entity will typically demand higher multiple than just the individual companies themselves. If your business is a potential platform company or a bolt-on company, this helps you strategize and understand why private equity firm might be coming to buy your business. Institutional investors often bring board expertise to your business. They can help with governance frameworks and strategic planning disciplines. This will professionalize the business and make it more attractive to future buyers. Regular board meetings, KPI dashboards, and formal strategic reviews signal maturity to future acquirers and lenders. Private equity firms and strategic growth partners will focus on a handful of things. They will focus on margin improvement, renegotiating vendor contracts, optimizing your pricing, as well as reducing your overhead. Further, they'll look to improve employee productivity and making the right investments in technology. Every improvement of EBITDA directly translates to a higher valuation of the business. This is where the hidden profits framework overlaps directly. Institutional investors have extensive networks of strategic buyers that may include investment banks or private equity buyers. These individuals, they can bring competitive tension to the sales process that typically a buyer themselves cannot do. Their Rolodex and reputation can get you in front of buyers that typically were not available to you before. Buyers will typically view an institutionally backed company as less risky. They typically will have better governance, cleaner financials, and more professional operations. This translates to higher multiples and a smoother transition process. It's a credibility signal to future buyers that says this business has been validated by sophisticated capital. If your exit is 2 to 5 years away and you need operational or financial support, a minority investor might be the right move for you. This might mean selling 20 to 40% of the business now, using that capital to make targeted improvements, and then selling the remainder of the business in the future at a substantially higher multiple. Everything we just talked about comes down to one thing: how your business is architected for value. I made a video where I show you the framework to identify these hidden profit levers and how to pull them. The reason I want you to watch it is because when you look at that framework and apply it to your business and pull those levers, it gets you the most value when it's time to go to market. Go watch that video next. I've linked it right here.